This week's quote is about the importance of humility, which is just as important in life as it is in the markets. If we haven't learned this lesson in life, we'll certainly learn it in trading. This quote covers many of the recurring themes in our videos: probabilities versus predictions, waiting for signals for entry and exit, and the simplicity of systematically following price. These concepts apply to the current precarious state of the markets. In this week's video, we'll review a checklist for a market bottom and look for signs of bottoming or breaking down. We'll also look at the 2011 correction for similarities and clues about the outcome of the current correction. First, we'll look at the summary of this week's economic data and interpretation. This week included multiple measures of inflation and the strength of the labor market. The textbook relationship of a tight labor market and rising inflation is not panning out. Inflation remains quite low, which gives the Fed cover to ease off steady rate hikes after December. The Fed is also tightening as they roll assets off the balance sheet. The data this week was strong, and there really isn't any supporting economic data for the near-term recession narrative. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. On Monday, the markets rose on record job openings, showing continued labor demand. On Tuesday, the market rallied on a presidential tweet about trade progress, only to be reversed by a televised tussle between President Trump, Nancy Pelosi, and Chuck Schumer over funding for border security. On Wednesday, trade talk progress lifted the markets. On Thursday, the markets closed roughly flat as the market considered Chinese cyber attacks on Marriott and potentially empty concessions in trade talks. On Friday, data showing weakening in the Chinese economy and European economies caused the market to sell off on growing fears of slowing global growth. The market closed down 1.21% for the week, and the month and year-to-date statistics are provided at lower right. In the past few videos, we've talked about the importance of signals. This week, we'll go through a checklist of things to watch for that will help us determine when the market is in the process of bottoming. First, we can watch change in speed or momentum of price. Divergences in momentum are very helpful in spotting potential market turns. Extremes in sentiment, when everyone is on one side of the boat, are also helpful. The market needs to find support to begin establishing a bottom. Often the market will test significant prior lows until it finds a foothold. In a decline, the market shifts to defensive assets. In the early stages of a bottom, investors' risk appetite returns. Once we find support, we want to see the buyers are back with higher than average volume on a follow-through day. Before we apply these concepts to the market, let's quickly review our understanding of momentum. Anyone who's played a sport or watched a game has seen a ball travel through the air. This means we're all familiar with the concept of momentum. When the ball is first kicked, momentum is very high. As the ball travels away from the kicker, the speed of change in height slows, even as the ball continues to gain height at a slower pace. And then we arrive at the moment we've all seen, where the ball seems to hang in midair at a high before it begins coming back down. Markets have moments where they hang in midair as well. Momentum of price is an extremely useful concept in identifying turns in the market. This is a monthly chart of the S&P, and the top panel shows RSI, or the momentum of price. Let's look at peaks first. Somewhere back here, the ball was kicked. Momentum rose to this high, and then began to decline, even as the ball, or price, went on to make a new high. When momentum and price move in opposite directions, we call it a divergence, and you can see here that we had a divergence right before the 2008 crash. Price crashed through the moving averages, tried to find a foothold, and failed. We can see that RSI continued to decline and broke through the center line of 50. Looking back at price, you can see that price continued to make a series of lower highs and lower lows until the bottom in 2009. So now let's look at bottoms from a chart perspective. Momentum begins to rise as price rises above a low or support and makes a series of higher highs and higher lows. This prior resistance level was tested and becomes support. Before the 2015-2016 correction, we get another bearish divergence. But note that in this correction, RSI did not break through the center line. Eventually, price finds support and momentum begins to rise again, which takes us to present day, where we have another bearish divergence and price so far is holding above the February 2018 low. It's better to look for signs of a bottom on a daily chart versus a monthly chart. This is a daily chart of the equal-weighted S&P, which gives us a cleaner view of the behavior of all the stocks in the index. Looking back at our checklist, we want to see rising momentum, a hold of support, and higher highs and higher lows. This green line shows that the equal weight index has successfully tested the February 2018 lows. We also see that RSI is making higher highs while price made another low during the retest. This is called a bullish divergence. For higher highs and higher lows, we want to see something like this, where we overcome a downward sloping trend line and reclaim the 50-day moving average, and the downward trend line becomes support. Now let's look at the next item on our checklist, sentiment. This chart is from a Twitter post by Urban Carmel. The chart itself is Hulbert's newsletter sentiment index. Newsletter sentiment is considered to be a contrarian indicator. By the time you read about it in a newsletter or Time magazine, it's old news and priced into the market. I'm a sucker for quotes, and I think that Jim Rogers sums it up well here. The chart shows broad stock newsletter sentiment in blue and NASDAQ newsletter sentiment in orange. To show just how powerful these contrarian indicators can be, here's a chart of the S&P. Now remember in 2016, we had just gotten back above the high that occurred before two back-to-back corrections, when on June 23rd we had the Brexit vote. When the UK voted for Brexit, stocks sank, and so did sentiment. When sentiment reached a bearish extreme, it actually turned out to be a very good buying opportunity. The current bearish extreme is lower than 98% of the readings since 2000. Again, these highlights are Urban's. This comment here about short-term stock timers reminds me of how we use the Commitment of Traders report in trading commodities. The contrarian indicator is what the speculators are doing. Usually the commercials are doing the opposite, and they're the ones that are usually right. Remember, we're looking at a checklist of items, not making decisions based on one or two items in the checklist. Now we'll look at risk appetite and volume confirmation. High beta sectors have more volatility or risk than the market. High growth sectors are also considered to be higher risk. Tech and small caps are growth sectors that usually lead out of declines. Tech has sold off significantly relative to other sectors in the decline, so let's see what tech is telling us about risk appetite. We have a bullish momentum divergence, price looks to have found support, and we have a higher low. What about S&P high beta? We have rising momentum and possibly support, but we need a lot more proof in the form of a series of higher highs and higher lows. Meanwhile, IWM, or the small caps, show a momentum divergence, but the rest of the chart is ugly, with lower highs and lower lows. Same for the financials. We really need small caps and financials to improve if we're going to form a bottom and rally. The last item on our list was volume and a follow-through day. Here's an inset from our chart that showed the Brexit low. Note that once price found a bottom, we were looking for a close above on higher volume that turned into a series of higher closes with higher volume on up days than down days. That's what you see in the inset. It's also what we don't see on a daily chart of the S&P that we'll see in a few slides. Here are several risk sectors in equal weight charts prepared by Arthur Hill. His Twitter handle is here. As you can see, all of these sectors are breaking down in bearish continuation patterns. If you squint hard at technology, you could try to argue for forming a bottom, but a descending triangle is a high probability bearish pattern. Until these find a foothold and investors come back in, it's hard to say that we have broad enough sector participation to support a rally. Now let's look at similarities between 2011 and the late 2018 correction. In 2011, the market was weaker coming into the correction, with a flattening 50-day moving average shown in blue. After the initial drop, we have a momentum divergence. In 2018, we also have a momentum divergence. Looking at the charts, you can clearly see that a momentum divergence does not mean that we're not going to make a new low. In fact, the point of the divergence is that you are getting a lower low on lower downside momentum. During the correction, we were below a declining 50-day moving average and a flat 200-day. In the 2018 correction, we were below a declining 50-day and have been above and below a flattening 200-day. In 2011, we have weaker candlesticks at the peaks with long upper wicks. In 2018, we have stronger candlesticks at the peaks. The market did become very overextended as it crossed over the 50-day moving average, which we did not see occur in the 2011 correction, but this is a bearish reversal formation, and price reversed strongly down. Looking at MACD in the lower panel, after a bullish divergence, we get this waning look, and then we get a bearish crossover. Same in 2018. In 2011, we were in a sideways consolidation and broke below the bottom of the box. Same in 2018. With all of these similarities and patterns, especially when we've made a new lower low, we're under a death cross, and investor sentiment is at a bearish extreme, it's a fair question to ask what happened next. Whenever we look at historical comparisons, it's important to remember that they aren't identical, and there's always a question of where we are in the analog. While we have broken below the bottom of the box in 2018, it is quite possible, looking at volume, that we're at this point in the analog. Bearing this in mind, let's look at what happened next. On the right side, we'll replace 2018 with the rest of 2011 into 2012. The chart ends where we left off here on this chart on the left. So what happened next? The market found support and recovered, going on to post a 33% gain over the next 6 months. Is that what will happen this time? Again, there's no way to predict. History doesn't often repeat, but it does often rhyme. What we need is a news catalyst to make it rhyme this time, and so far, we haven't had it. So let's bring it all together on this daily chart of the SPY. You can see where the moving averages are serving as points of overhead resistance. Here's our consolidation where we broke below the box, and the break seems to have found support around this cluster of lows in late April, early May, and we're still above the February low. However, with today's sell-off, we've touched the bottom of the box again, matching the October 29th low exactly at 259.85. It should be noted that the earlier chart of the equal weight S&P now also has an additional touch of the February low. The more we touch a support level, the greater the likelihood of breaking through it. So let's look at our checklist. We have our momentum divergence, but we're going to have to change the line color from green to orange. Much like the 2011 case, today's sell-off caused a low that was below the original trend line that was drawn in green. It remains to be seen if this holds. We have extreme bearish sentiment. We may be finding support, but it's a bit early to tell. And we just don't have enough of an indication of risk appetite yet. We also haven't seen follow-through in terms of higher closes with volume confirmation. To answer our opening question, we're still in a range. A test of the February lows is looking increasingly likely. A break and closes below would certainly rule out bottoming. Remember, the average length of corrections going back to the 50s was 126 days, and at 86 days, we're only about 68% of the way through. So what do we need to get our Christmas wish for a reversal? We need narrative-changing news that addresses one of these overhangs: the trade war, slowing global growth, or Fed policy. We have a Fed meeting next week and the start of earnings seasons in January. Any other headlines, good or bad, will occur without warning in the interim. All we can do is pay attention to the behavior of price within the current range and watch which way we break out. We have a plan for either case. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.